Thank you very much for everyone for joining us. Myself and Braden are here to welcome Nevin to have a catch up on Reserve, both the protocol and the RPay side, hopefully. And in light of what has been a very eventful month, we had to delay this chat until now due to diary clashes. But hopefully, we've got a lot more to discuss than we would have had. And I think, I could be wrong here, but we were just checking the last time we did anything like this with Nevin was about a year ago. But anyway, we will. I think what we'll do is we'll go for an hour and then just see how people are for time and things like that. And if we've got any more time, we probably have some emergency questions or whatever. So I think what we'll do is we'll kick off with potentially the events that have just unfolded over the last couple of weeks, maybe starting on Friday the 12th. So the first question is very open. Nevin, in your own words, can you describe the events of the last few weeks?
Yeah, sure. And just logistically, I have an hour and 45 minutes available. So if we want to take more time, I'm happy to do that. But we can make a call later.
Okay. Cool.
So, and first off, do you hear me clearly through my microphone right now?
Yes.
Yeah, I do. Yep.
Okay, great. Okay, so the events of the last few weeks. I mean, so obviously, the general backdrop here is issues in the U.S. and possibly global banking system. And I'm sure everyone has been doing their best to like follow that and understand what's going on. I'll just summarize really briefly my understanding of the fundamentals, right? So basically, during the COVID era, rates were brought down to zero, basically to stimulate the economy during lockdown and keep things going, keep liquidity in the system, and so many banks, not just SVB, but many banks had a whole lot of deposits and didn't know where to lend out that money, and we're looking for any way to make money on those deposits in order to cover their expenses and possibly even increase expenses because they had so many more deposits and depositors to deal with. Why did they have more deposits? Well, that's apparently just because of the stimulus money and of the fact that the economy was juiced and was heating up. So there were a lot of cash reserves that were accumulating, especially that's going to be especially true in tech, and SVB would have gotten a big boost. Also, other crypto banks started to achieve more prominence and grow their deposit base, Silvergate and Signature in particular. And so banks, but not just crypto and tech banks, many banks are shopping around looking for places to put that capital, those deposits. And something that looked very safe at the time, but in retrospect was riskier than people thought, was to buy or basically lend money to the US government via buying long-term US treasuries. And so that means basically making a loan to the US government for something like 1.5%, which feels good in a zero interest rate environment. But the term of that loan is maybe something like 10 years. And but if you're a bank, it's not like you're locking up that money for 10 years because you're like, well, I'm loaning this money to the government. But treasuries are generally highly liquid because a lot of people regard them as the safest asset in the world. And so if you need cash, because if your depositors come and they want to withdraw that money, that you can just sell those treasuries on the open market in order to be able to pay for those withdrawals that your customers want. So it's like, okay, we'll get 1.5% or something like that on our money. And if our customers want to withdraw, no problem. We'll sell the treasuries in the very liquid market and we'll fund those withdrawals. Well, as many of you again probably know, because if you've been following this, but I'll summarize it. Basically, as the Fed ended up increasing rates in order to combat the inflation that came about from printing all of that money and putting it into circulation during COVID, what that does is it makes those treasuries less and less attractive on the open market. And this is, I'm going to spend a moment on this because it's a little bit counterintuitive if you haven't really thought through it before, and it's worth understanding. So, if you're holding this treasury that the U.S. government is going to pay back in 10 years, the way that works is that when the treasury issues these assets, it does so in an auction, and it says, okay, here's this piece of paper or digital record these days, and it says that in 10 years or whatever the period of time is, we'll pay you X amount of dollars. It's like $10,000 a pop or something like that. But let's make it simple and just say it's $1. Okay, so here's a piece of paper. I'll give you the piece of paper, and then in 10 years you give it back to me, and I'll give you $1. And then the return on those, like the interest rate, it's not actually written on the piece of paper. The piece of paper just says that you'll get $1. But then they're sold in an auction. So basically people come and say, well, I'll pay, whatever, I'll pay like 80 cents for that piece of paper, which would be worth, $1 in 10 years. And someone else is like, oh, I'll pay 82 cents or I'll pay 83 cents. And then, whoever bids the best ends up purchasing that piece of paper. Let's say that someone buys it for 85 cents. Okay, I'm just making up numbers here for an example. If you do that, then now there's a 15% difference between the purchase price in that auction and the value, the dollar that you'll get when that bond matures. Okay, and so you divide that by the number of years, and you get basically the interest rate that's set in that auction. Okay, so let's just say that for a 10-year bond, someone paid 85 cents, and then in 10 years they'll get $1 back from the treasury. Well, so you might think that that bond at that time is worth 85 cents, and the closer you get to that 10-year mark, the value would approach $1 because you're getting close to the point where you could get $1 for that. But what happens is if the Fed decides to manipulate the interest rate environment, which it does through various other means, which this is maybe already too much detail, but so I'll skip over that, to the point where those auctions are clearing at a different price. Maybe now people are expecting to get, instead of 1 or 1.5% per year, they're expecting to get 4.5% per year in the current interest rate environment. Well, if that's the case, then let's say you're holding a bond that still has 5 years left on it. The market's going to look at that and say, okay, well, on these short dated bonds, I can already get 4.5% per year. And so I would need to get 4.5% over the course of 5 years in order for that to be attractive to me. Okay, and so let's use the calculator. So say 4.5% times 5. So that's, I'm not really thinking about compounding here, just doing simple math. That's like 22.5%. Okay, so if we do 100 minus that, that means that someone would be willing to pay in that market 77.5 cents for that bond that maybe you paid 85 cents for when it was going to take 10 years to mature. Now it's halfway through, but it's worth less than what you paid for it. It's worth 77.5 cents because people know that they can go purchase these other newer bonds that have a higher return. And so when people talk about this phenomenon of like the Fed raises rates and that drops the value of these long dated treasuries that the banks were holding, that's what it actually means. And so basically we had a situation where many banks, looks like over 100 banks in the US and possibly many globally, I'm not sure, are started to basically have all these assets on their balance sheet that are there to basically back customer deposits and allow people to withdraw if they need to. But those assets ended up depreciating because of all these higher interest rate bonds that are more competitive, which devalues these old ones that the banks are locked into. And so basically, as soon as that became clear to enough people in the market, that's what starts to lead to the bank run challenge. And so that's fundamentally what got us here, right? And so now let's get into how does this spill into crypto, and how does this spill into eUSD and Reserve? So basically, the market, became aware of the Silicon Valley bank run, and very quickly after that, the team behind USDC transparently announced, hey guys, we just so you know, we have about 3 billion in cash. It was like 3.3 or something with Silicon Valley Bank, and we don't know what's going to happen with that. And that was, I think, something like 8% of the total assets backing USDC. And so very quickly, the market priced that in. The market's like, oh shoot, USDC is maybe, if SVB fails and those deposits aren't insured, USDC might only be worth something like 92 cents because like 8% of the backing might just be gone. And so, it's very interesting. Well, okay, there's more to say about that, but that's the basic thing that happened. And so, as I'm sure everybody on this call, saw, I'm sure everyone was watching their screens over that weekend, USDC did in fact depeg. People started trading it at that lower price. And something that was very fascinating for me, because, we've spent hundreds or thousands of hours like thinking about all these different default possibilities and thinking about what stablecoin depegs could look like and so on when thinking about how the protocol should work. Something that was so fascinating for me was that I'm very used to a situation where no matter the time of day or night, no matter the day of the week, we can ping different OTC desks around the world, and often they'll respond over chat in like a matter of a couple seconds. And they'll be willing to quote us prices for trading various different crypto assets, especially stablecoins. But that weekend, nobody was quoting a price for USDC because everybody was so uncertain about what was going to happen. And so the liquidity in the OTC marketplace for USDC just completely, went away all in basically a moment as soon as Circle had announced that they had those funds with SVB. And so, USDC was actually like quite volatile during that weekend. There was trading on exchanges, but it was very unclear what was going to happen. And we ended up selling some USDC at a discount because we weren't sure what was going to happen either. And we were like, well, we could take a small loss now, or we could risk, funds being locked out for years in bankruptcy or something. And so, anyway, obviously it was a nightmare scenario. And it's so funny because just a couple of days before this, I'd been thinking to myself, okay, maybe we should create some sort of test RToken that is somehow intentionally not sound, that we can sort of intentionally push into a default in production, not on the testnet, like a real one with a small amount of capital, maybe our own capital, in order to test the protocol live and require the whole process of auctions and so on and so forth, in order to demonstrate to everybody in our community and any onlookers how the thing actually works in the case of a default. And I was thinking about doing that test because I was figuring that it might be a very long time before an organic default occurred. And so we might be in the situation where like we've just talked about defaults in hypotheticals and in our documentation, but no one's really seen it. And so no one really actually clearly understands how things would behave. So I wanted to sort of make this test case. And then lo and behold, like a couple days after having that thought, USDC of all things ends up depegging. So, completely crazy, but also a sort of very interesting opportunity for the Reserve protocol to show how it works. And so obviously we're like, okay, the rubber's hitting the road, this better work. And so, for anyone who doesn't know, eUSD, which was deployed by the MobileCoin team, was backed by essentially 50% USDT derivatives on Compound and Aave, and 50% USDC derivatives from Compound and Aave, C tokens and A tokens. And so those C tokens went into default. The protocol recognized that. And another thing that's interesting is that because DAI is pegged to USDC, because it's predominantly backed by USDC and it's basically issuable and redeemable directly one-to-one with USDC, DAI also went into default. And DAI wasn't in that basket, but it was one of the three emergency backup collateral assets that were defined for eUSD. And so, hilariously and somewhat ironically, I guess, USDT was the safe asset of that weekend. It was the backup asset that was still not in default. And as many people probably saw on the charts, USDT traded at a premium that entire weekend because everyone was rushing to it. It's kind of funny, but the fact that its backing is a bit more opaque might have been a good thing in that scenario because there was nothing concretely to freak out about. Maybe USDT actually had some funds at some banks that could have been called into question, but nobody really knew if that was true or not, and so there wasn't any concrete reason to be afraid. And just as a tiny side note, this is actually apparently how the monetary authority of Singapore operates. They peg their currency to the US dollar, but they decide how they're going to adjust that peg, and they maintain various different assets in the background to maintain the peg, but they don't tell the market publicly what their intended exchange rate is. And I think they're also not transparent about the assets that they have in the background to manipulate that market. And in part, the reasoning is because if you show that you have assets to maintain a peg, but you don't have enough, people might freak out and stop trusting that that peg is going to stay. But if nobody really knows how much you have, then maybe you have 100%, maybe you have 120%. Nobody really knows, and so nobody ends up deciding to attack it or sort of exhibiting a bank run dynamic. So anyway, that was USDT over that weekend, and so it was very exciting to see the auction process happen, and that happened like 99.9% successfully. There was one thing that went differently from how we had imagined it, and it's because of a safety measure that is built into the protocol. And so I'll explain that, and then sorry for this very long-winded answer, but then that should set a good backdrop for the rest of the conversation. So essentially, the protocol did successfully auction off its USDC denominated collateral for USDT, just pure USDT, by the way, not C tokens and A tokens, because that's how the backup basket had been defined by the MobileCoin team. And what's so cool about that, by the way, is just that with some crypto protocols, there's sort of these backup measures in place, but oftentimes the backup measures require humans to come in and cast governance votes in some way or another to basically say yes, we approve this action, or we're willing to pay for this, or whatever. In this situation, the way that the Reserve Protocol is designed, it obviously does have a governance element, but in the case of a default, no governance is required. Everything is predetermined, and the protocol just ends up allowing anyone to come submit certain transactions in order to start rebalancing auctions for collateral, and then also for the RSR over collateralization. And so what's really cool about that is that as an eUSD user, or any RToken user for that matter, you don't need to trust that a particular group of governing participants is going to step in and say, yes, we deem this to be a problem, we're going to back it, right? Contrast that to what's happening with FDIC and the Fed, where over that weekend, everybody was waiting for what is the Fed going to say? What is FDIC going to say? Are they going to back these or not? There's this massive uncertainty, and everyone is completely losing their minds in the meantime because they're dependent on those particular, governors to decide, yes, we're going to back this, or no, we're not. And so the beauty of, of the way that the Reserve Protocol performed that weekend is that there was no ambiguity at all. You can just read the documentation or look at the code, or like listen to someone who understands it well. And it's like, yep, this is what's going to happen. This is all thought through. There's no decision making. There's no ambiguity. It's just going to play out. The collateral that's defaulting will be replaced by new collateral. You can see the exact list of what that's going to be. And then if there's a shortfall, then staked RSR will be seized and sold in order to make up for that shortfall. Pretty straightforward. Now, the one thing that didn't go the way that I had anticipated it would, or that anyone had anticipated it would, is that the protocol has this safety measure built in that basically says if the protocol sends tokens to an auction contract to auction off, it has a certain expectation about the number of tokens it will get back under certain conditions. And if somehow it gets back a number of tokens that doesn't make sense to it, then it will basically throw a flag and be like, hey, something might be wrong here. Instead of continuing to trade, which could cause a loss, we're just going to pause ourselves and we're going to wait for governance to basically come in and make an adjustment if needed, or say, yes, you can continue trading. And so this runs a little bit counter to what I was just saying, right? Because on the one hand, that's a safety measure, but on the other hand, now you're bringing in this human judgment element. And I think this is something for the community and the team to sort of like look at closely and think about, like, well, was that a good outcome? Was that a good safety measure, or was that actually bad? Because in this case, what happened was, in my understanding, and our engineering team might have a slightly better take on this because they've done a retrospective and I wasn't part of that conversation this last week. But my understanding is that basically the difference in tokens that, from what the protocol was expecting to what it got was off by like a millionth or something, like some tiny amount that, like, in reality, we sort of wish that it wouldn't have thrown that flag. It's like, yeah, that's not a problem, continue trading, do your thing, it's going to be fine. But because of that sort of extreme conservatism in that safety mechanism, then the protocol had to wait for 7 days for the whole governance cycle in order to be able to continue trading. And so what that meant is that eUSD did deterministically and mechanistically sell off its USDC collateral for USDT, but it didn't sell off staked RSR to make up the couple percentage points of loss in order to make eUSD holders whole. It will do that as soon as this very simple governance proposal to just re-enable the trading mechanism is passed. And so I think that it's going to end up being like on Tuesday is when that auction is going to be eligible and presumably will run. And so again, it is still like relatively deterministic because RSR stakers, until this default process fully plays out, they can't unstake. Ordinarily, there's a 2-week delay for how long it takes to unstake, so that stakers can't decide to just run for the exits in a moment of panic. But once a default is triggered, then that unstaking delay basically just is persistent until the RToken is recapitalized. So even if it were to take an extra week or 2 weeks or something for some reason for this to get sorted out and the RSR to be seized and sold to make up that difference, that doesn't give the stakers a window to peace out. There's no risk to the eUSD holders that all of a sudden the RSR backing would go away after 2 weeks and they wouldn't be made whole. So that's good. The team thought that through very carefully. And so, yeah, that's where we're at. So basically, the trading mechanism, I think, will be re-enabled on Tuesday, and that will allow the selling of a small amount of RSR. And I have some thoughts about like RSR, staking economics, and so on that will be sort of an extension of this. But let me kind of pause here. That's my description in my words of kind of the big backdrop and the things that have happened with crypto and Reserve over the past couple of weeks.
Yes, well, that was a very full and detailed explanation, which is really great because that sets the bedrock really for the conversation that we can have. It's interesting that a couple of points happened that probably they're external to the protocol. There's nothing anyone could have done about them. Tether seemed solid as a rock, and nobody really knows what's going on with Tether. So it's very interesting that people didn't trust a company that came out and said, "Look, we're being honest with you guys. We've got 3.3 billion sitting in there. We don't know what's going to happen to it."
Right.
I guess they could have said, "Well, full disclosure, we've actually got loads of cash in the bank," but that's maybe it's by the by. And secondly, it happened on a Friday, and if I had my tin hat on, I might suggest that it was done on purpose on a Friday because the banks shut for the weekend, and then
Right.
the only markets that get affected subsequently are crypto markets. But yeah, maybe that's not worth thinking about. But yeah, great answer, thank you. And I'm going to hand over to Braden for the next question.
Nevin, were you completely done there, or did you say you had something else you wanted to say?
Well, at some point in the call, I want to talk about the economics of RSR staking because I think it's a good learning moment, but it doesn't have to be right now.
Well, okay.
Yeah,
Why don't we do that now?
Yeah,
Okay.
I don't see any like easy place for it to fit in. Not being weird,
Okay.
just yeah.
Okay. Cool. Okay. So this is like a little bit hard to do without visuals, but I think it's worth talking about. So, one thing that that I think is just really important for everyone to understand when they're staking their RSR is, what is your expected income going to look like and what are your expected expenses going to look like? And, the main expense that you can be subject to as an RSR staker, of course, is if there is a default, then your RSR can be seized in order to cover that default. And I think many people understand that, but I do worry that some people who are more on the very edge of the reserve ecosystem, who bought some RSR and they're excited to stake it, but maybe they don't really know what that means, I worry that they would not quite understand these dynamics. And I think that this is a great opportunity to try to spread the word. And so I'm saying this to the people on the call, but also I encourage you to, talk about this on Twitter, talk about this in the Discord, try to educate people who are less involved than someone who's going to, hop on this inside baseball conversation on a Sunday. So, basically the way that you can think about it is that your expected return on an annual basis basically comes down to the APY that you'll get from any revenue that the protocol is generating and diverting to RSR stakers. So, if the underlying collateral that's being lent out, let's say it's generating 2%, and then let's say like with the USD, all of that's going to the stakers, then it's like, okay, 2% of the, RToken market cap in revenue per year, right? So like, let's say that it's a good number to use. Let's say that the RToken market cap is 100 million, then that would be $2 million per year in revenue going to the RSR stakers. Now, as I think many of you understand, but just to be clear, that doesn't mean that a staker will get 2% APY. If there's the same amount of RSR staked as the size of the RToken, so in this case, it'd be like $100 million worth of RSR staked, then you would get 2% APY because you have $100 million worth of RSR getting $2 million worth of income and dividing it pro rata. But let's say that, only $20 million worth of RSR is staked on a $100 million RToken that's getting 2%. In that case, you have, it's going to be a 5x multiple, right? Because 20 is 1/5 of 100. So that means that you would get 2% times 5, you'd get a 10% APY as an RSR staker for your income. But that goes both ways, okay? And this is I think, the important point I want to try to get across. And and the situation with eUSD is like a cool example of this, where the less RSR there is staked, the larger fraction of the revenue you would get, but the larger fraction of a default you would need to cover in the case of a default, right? Like, let's say that there's a default and you need to cover a 2% hole, which is roughly what's happened with eUSD. Then, if there's only, 20 million dollars worth of RSR staked on $100 million RToken, and it has to cover a 2% hole, which is $2 million, well, then that's 10% of everybody's staked RSR that would be seized. Whereas, let's say that you had $100 million worth of RSR staked on a $100 million RToken, and the stakers had to cover a 2% hole. Well, that's obviously only 2% instead of 20%. Let's see, am I doing that right? I think I might have.
Yep, I think that's.
Yeah, that's right. Yep. And so, 2% instead of 10%. Yeah. And so so you can see that, like, basically the more stakers there are, the smaller the hit will be in the case of a default, along with the fact that the revenue that you would get would be smaller. And so that's one kind of nice thing about what's happening with this eUSD demonstration, is that because so many people have staked, because eUSD is so much more over collateralized than just 20%, we're going to all share that hit of RSR being seized in such a way where it's going to be, I think, probably less than a 2% reduction in RSR for all of the RSR stakers. And so it's not going to hurt very bad. It's going to be, not too bad of a situation. But on the flip side, because so many people have staked RSR, the income that we're all earning as stakers is not very high either, right? And so, as eUSD scales up, we'll see where this equilibrium ends up settling. I think we had an interesting situation where a lot of people were just very happy to stake for any amount of income, and very sort of eager to just get involved and participate. And so that's why we have such a large over collateralization of eUSD, which I don't think is realistic at scale. I think that the market will end up demanding a higher return for staking at scale. But yeah, it made for a nice sort of experimental case. And so, yeah, I guess just to round that all out, sort of saying that all one more time in a slightly different way, I had been kind of nervous that there was so much RSR staked and that RSR holders would be disappointed with the short-term APY that they're getting on staking on USD, because the total USD market cap had been pretty low at the very start. But then it turns out to kind of, because it goes both ways, it turned out to be a blessing in disguise, because of the fact that when this default happened and we had to cover it, it was such a small hit to those stakers. So I hope that this overall situation, and I hope that explanation is helpful for thinking about the economics of staking, thinking about the risks along with the benefits. And again, I would love it if you guys help explain that to people who are less tapped into the community and paying less attention, because it's more complicated than many ordinary instances of staking. It's even more complicated in a way than proof of stake dynamics when you're staking, because if you just are running a validator that's never going to lie and never going to get slashed, then you sort of don't even really have to think about the slashing. You're like, yeah, slashing only applies to people who try to defect, and so my income is just this predefined staking reward. The economics here are a little bit more complicated, and so it's important as we grow the community for new RSR holders to learn about how that works on the way in the door, so they're not surprised in the case that further defaults happen. And then one last thing I want to mention is that with the eUSD situation, interestingly, you can look back on it and say, well, it actually would have been better economically if the protocol had just waited and held that USDC and everything resolved and it returned to peg. But the thing is, on Sunday, I think it was like Sunday morning, when that rebalancing happened, we didn't know yet whether that was going to be the outcome. At that point, it totally could have been that USDC stayed depegged and Circle went into bankruptcy and so on and so forth. And so, this is something that we thought about long and hard when designing the protocol. It's like, well, do you want to give the protocol some sort of flexibility or some sort of control by governors to basically decide like whether to sit on defaulting collateral and hope that it reappreciates or not? And we ultimately decided, no, we should again have it be completely deterministic so that you're not dependent on any human action and there's no opportunity for humans to come in and try to exploit any control that they could take in those moments. But yeah, it's interesting because we are covering, as stakers, we're covering this 2% hit because the protocol sold at a discount. When perhaps if it had gotten lucky and USDC had repegged prior to that moment, maybe we wouldn't have to cover that cost, and that is something that could happen again in the future, right? Because that same sort of dynamic could occur. I think that it was kind of a perfect storm to have a collateral asset trading at a discount for such a short period of time and then repegging. That's actually not really something we've seen quite to that extent, I think, sort of ever before with stablecoins, but it totally could happen again. And so I just want to acknowledge that, like, in a way, it kind of sucks to cover that shortfall when it wasn't necessary. But thinking through all the dynamics, it still seems to me like that's the right policy. And then, luckily, it's not too painful in this case, and it's a great demo, and it almost helps the Reserve protocol market itself, just to show how that all worked. So those are my my sort of follow-up thoughts on the economics of RSR staking, and I hope that's somewhat helpful.
Yeah, we'll hopefully get the word out. It might be worth maybe a couple of examples on Register to kind of say this is what happens if there's a default, and a 5% example or something like that.
That's a good idea. I like that. Yeah, we should suggest that to Luis. And I know they have a lot of requests now that people are using it in practice. So I'm sure it wouldn't happen immediately, but yeah, it's a good idea. Let's ask.
I think also the conservative nature of the protocol to be safe faster than waiting is also a good thing, because if you link that to the likes of the security services or whatever, you don't thank them for being safe because they've made you safe. You thank them when it goes. You're really angry at them when it goes wrong, and that should go
Right.
wrong a very few number of times. So you don't get thanked for being safe, but it's the better situation to be in the longer run.
Yep.
One thing I do want to say is that on the flip side of all of that, even the 24-hour timer of the protocol before the auction starts, after the flag has been risen, did actually save stakers a considerable amount of money, given that USDC went down to 89 cents, so it could have been 5.5% instead of under 2, essentially.
Yep.
If it was like a
totally.
12-hour and that was where it was at 12 hours, essentially.
Yep. Yeah, and so in a way we got lucky, whereas maybe that 24-hour delay in another default scenario would have the opposite effect, depending on what things happen to be trading at that mark. And so yeah, but we kind of think that, like, there's sort of no way to have the crowd or the protocol intelligently trade those moments. You kind of just have to have some sort of rote strategy, like wait 24 hours and see if it's still depegged, and if so, call it there. But I will note that is a parameter that's configurable by governance, that 24-hour period. It doesn't have to be 24 hours, I believe. And so perhaps over the course of the years, as the ecosystem gets more experience with stablecoin defaults, maybe it will be determined that it should be 12 hours, or that it should be 3 days, or something. That's something that can be changed over time.
or if it's a weekend, then slightly different rules.
That's it. Yeah, no, that's actually a really interesting idea. I wonder how.
Or if it's outside
Making
of
me wonder,
banking
like,
hours, ultimately.
right,
Yeah.
right, yeah, like time on the clock is, the time of the day is maybe an interesting variable, and yeah, and we kind of realized, like, oh, wait a minute, so like the flag's going to be raised at a certain time, and there's a 24-hour delay, and then there's another 6-hour delay before the trading can happen, and so that means if someone calls the transaction to raise the flag, in the evening, in their time zone, that means that necessarily the trading actually opens up, in the very middle of the night, or in the early wee hours of the morning. So anyway, there's all these, things that we got to experience live for the first time of, time zones and all of that stuff. So yeah, it's interesting. You actually could maybe have a rule set that's sensitive to those things, but obviously there's, someone's always asleep somewhere, so maybe there's no optimal time.
Yeah, I guess. I've just read through all our questions, and we're going to flip flop a bit. We're going to go backwards and forwards a little bit, but that's maybe a little bit more interesting rather than kind of going down a long thread and then swapping over. I'm trying to justify myself here, but never mind. Anyway, Braden, I think you're up next.
Okay. Hey, so some of us are curious about the next stages for RPay. Can you give us some hints or information regarding their future plans?
Sure. So, I mean, in general, I try to let Gabo be the one to speak authoritatively on RPay and their plans because he's really the one in charge. So with that caveat in mind, I can say a little bit, which is, RPay is exploring offering services in the US, as we've mentioned. One thing I want to note about that is that now is a terrible time to go to market in the US as a crypto payments company, because of the massive assault on on the crypto industry when it comes to banking in the United States. And that is largely because of the terrible black eye that we all have from what Sam Bankman-Fried and FTX did. And so, the conversations with banking partners are extremely difficult right now. And so that may make it, that is making it a much greater challenge, not to say that it's going to stop the team from making it work, but it's a much bigger challenge to start offering the kind of services in the US that the team is working on. But with that, with that detail out there, the general intention is the following. It's basically, okay, there's this user base in Latin America that has grown to a certain size. We could just continue focusing on Latin America, but the goal of RPay has always been to offer a global platform. We want there to be a global platform that makes it possible to use RTokens as money. And there are further mission objectives for the RPay team that go beyond what I just said. But in basic terms, and if you're thinking about it from the protocol perspective, that's kind of the basic way to think about what RPay is doing. And so there's a question of how do you get from just a few countries in Latin America to the entire globe, and it really has a lot to do with, like, how do you take existing network effects and make use of them to gain new user bases and grow that network of transactors all around the world. And the US seems like a natural hub to do that. So basically, if we can make it so that our users in Latin America and in other countries in Latin America that are perhaps easier for us to open up in, given our team and our background and our skill sets and stuff, if we can make it so that those users transact back and forth with users, people and businesses in the United States, then that can help us establish a foothold in the United States, both in terms of the infrastructure that we're able to build and the early user base in the United States. And then once we have that infrastructure, if that all works, then the reason why the US is an attractive hub is that so many different countries around the world transact with the US because it's such a big economy. So if we can get to the point where we have a level of infrastructure and know-how and user base in the US similar to what we have in countries in Latin America, such as Venezuela, then that gives us a nice early foothold for then being able to facilitate flows of money from the US to places all around the world. So rather than going from Latin America directly to, say, Asia or Europe, we think that basically establishing a US presence is the correct strategic move to sort of parlay that Latin American user base into a global user base. So that's the high level idea. But again, going to market in the US is very challenging right now. And so we'll see how that plays out. And I think, I'm trying to think if there's any other interesting details. I mean, obviously, we're very excited for the transition from RSV to eUSD within RPay. And, for over the past several weeks, some people have been asking, like, so when is RPay going to actually use an RToken? Some people have understood and have been following along. They're like, yeah, that might be a while because we want to, let it be tested in practice before we scale it up. And some and others were kind of upset, like, hey, this is live, why aren't you switching over? And honestly, we did not intend, the RPay team did not intend to make the switch this quickly, simply because they wanted to let the smart contracts have more time in production before relying on them to store user funds. But after the recent events, it sort of looks like, well, yes, there's some smart contract risk, but actually this seems like a safer option than the current RSV system, because the RSV system has no over collateralization. And so yeah, it's kind of a crazy moment, but the RPay team decided to go ahead and make that update and rely on eUSD. And what they did is they redeemed a bunch of the RSV that the company in the background holds in order to provide liquidity to RPay users, so that the amount of RSV that it's in existence now is closer to the total balances of RPay users. And they did that in the short term just because there was a need to reduce that exposure to USDC. But then that actually kind of makes it more feasible to make this switch, because I think the plan is basically something like $6 million in increased eUSD market cap in order to cover those user balances, rather than something like $27 or $30 million in USD market cap. And that's a lower risk, right? If there did happen to be a bug in the reserve protocol that's still alive, then in the extreme case of total loss of funds, $6 million is something that the company behind all of this would have an easier time covering than if there was a much larger loss. So it makes it feasible to go ahead and do that migration to eUSD sooner. And then as the RPay team mints more eUSD in order to provide more liquidity, and if the user base scales up and those balances scale up, that should happen, not too quickly. It should happen slowly over time. And so it's okay to take that risk as that scales up. So super excited that we get to see that transition to eUSD in the short term. I believe that the way that they're going to operate is that you'll be able to deposit and withdraw eUSD on Ethereum within RPay initially, not on the MobileCoin chain. That would take additional development, and it's not quite a priority yet, I think in part because the ecosystem for using tokens on the MobileCoin blockchain is still young. But that also makes it an easy switch, because all the same infrastructure that the team has already built to allow users to deposit and withdraw RSV as an ERC20 token can be easily repurposed to support eUSD. And so that's going to allow them to make the switch very quickly. And so, so the switch will occur, I believe, this coming Wednesday, which is, after the moment where USD will have been recapitalized from auctioning off RSR. And yeah, we'll be excited to see how that all goes.
Cool. We are too. Definitely. I mean, we're also excited for the product that has actually gone through and proven itself unexpectedly so soon. So, with that being said, okay, so there's one thing that I didn't have um, like perfectly prepared here, but so on register we see this high transaction volume per the circulating supply of RSV, and so we might see like 15, 20, or $30 million transacted in RSV in 24 hours. And so a lot of us were quite surprised seeing that, in just a 30 million approximately market cap stable coin, that's indicates a pretty fast movement of the money. But with it only
Yep.
being 6.5, approximately, that is, 4 times more. And so, what do you have? What do you think about that?
Yeah, I mean, I think that that's so okay. There's kind of two pieces there. I mean, one is just because it's a transactional application that's meant for using it as money. There just turns out to be a high amount of transactions compared to people holding it, compared to maybe some use cases where someone is like speculating on the crypto, so they buy and hold it for a long time. But I think the other critical thing to understand this is that a lot of the biggest transactors, the ones that are doing the largest transactions of sometimes millions of dollars at a time, are businesses. And those businesses are often relying on the RPay network to get their capital into or out of US dollar bank accounts because they want to transact with their suppliers, like others in their supply chain, basically. Or they just want to store capital and they don't trust storing it in an application like RPay yet, right? It's still new. If you have the choice of storing it in RPay or storing it in Bank of America, where are you going to store it? You're going to store it in Bank of America. I guess these days, maybe that's like, maybe banks are being called into question a little bit more, but still. So what that means is that a huge amount of the volume each day is businesses moving money in from local currencies like, Argentine peso or Colombian peso or Venezuelan bolivar, and then moving money right back out in order to get those funds into an American bank account, or sometimes vice versa. And so that's the fundamental driver of how you can have, such a high transaction volume on such a small circulating supply. And then, if you separate it out and you look at just the retail transactions, it's still very high transaction velocity because there are so many payments and stuff happening and people moving money in from one source and out to a different location and so on. But yeah, the biggest driver of those volume figures that makes it seem so lopsided like that is those businesses doing those large transactions.
Okay, I appreciate the explanation.
Yep.
Actually, if we kind of continue along the eUSD route, MobileCoin's network seems to be really good. It's super fast. It's super cheap.
Yeah.
Are there any network effects, two-way network effects from the MobileCoin blockchain and RPay or something like that?
Oh, I mean, I think there certainly could be in the future. There's definitely not yet because it's so new. But absolutely. I think that I'm super excited about the user experience using eUSD within Moby. For anyone who hasn't tried it, it's totally worth trying it out. You can go download Moby on the App Store and you can get your funds in and out through other cryptocurrencies. And I believe they have a fiat banking connection now as well. And so, yeah, like if Moby is successful, it will be a competitor to Cash App and other methods of storing and moving money, but it's global from the beginning. Because it's a user custody crypto wallet, it's something that is much easier from a regulatory perspective for them to offer to people anywhere in the world. Now, obviously, they need to establish fiat on and off ramps, and that's something that our team talks to them about because we have a bunch of experience with that. But yeah, I do think that there could be network effects there. I also am hopeful that other players in the crypto world and outside the crypto world will end up supporting the MobileCoin blockchain and that version of eUSD. So I think that network effect could end up going beyond just the Moby application. I'm hopeful that the Signal team will integrate eUSD. They already support MobileCoin, and so to me, it seems like a natural step for them to support eUSD so that their users can hold money and spend money in US dollars, which I think people would like to do if the user experience is good enough within Signal. So, but as we've said before, that's not in our control. It's not like Signal has signed a contract saying they would do that or something like that. It's up to them. But I think it makes sense, and I think that could be a very cool step for the Reserve ecosystem is to be able to power the stablecoin for Signal. So I'm hopeful that will happen.
Yeah, great. I think for me anyway, the worldwide aspect is great because you can, for a quarter of a cent, send dollars anywhere in the world, which is which is pretty difficult to do with right now. So if they get the fiat on-off ramps in the rest of the world right, then this to me is kind of almost the same as the first telegram crossing America from New York to San Francisco, which puts the Pony Express out of business in a week.
Yeah, totally.
Anyway, so over to you, Braden.
Okay. Hey, so from your point of view, now that we've seen the protocol function as intended, how does the narrative shift with RTokens in the next 3 to 6 months?
Good question. I kind of have to think about that a little bit. Well, I was on this call almost 2 years ago with the founder of a very large fintech platform from Latin America. And it was our first call. Our teams were getting to know each other. And at some point he said to me, Nevin, with all due respect, I just don't understand what is the point of RSV, because RSV was what was live at that time. Why would anyone use a stablecoin that's a basket of other stablecoins instead of just using USDC or something directly? And I tried to explain, there's possibility that there could be regulatory pushback on one of these stablecoins or something could default, and you don't want to be dependent on any given issuer. And it's sort of yeah, okay, fine. But I don't really, nobody really believed that could happen. Nobody really thought that Paxos would be told to shut down BUSD. Nobody really thought that USDC could depeg. And so his response was sort of okay, yeah, all right, fine, sure. But but he was not convinced. And that makes sense. It's unless you're a prepper type person who thinks about all these things, like the reserve team, then it sort of seems silly to worry about those things in a world where nothing like that has ever happened. And so I think, or at least I hope, that given recent events with stablecoins, given the live example of eUSD responding, without breaking a sweat under these circumstances, I think that it might be the case, that people recognize the value of that system. And that's not even to talk anything about the long-term vision of Reserve or the thing we want to do with asset-backed currencies and non-fiat money and so on. It's just a simple safety tool for end users, and it's just a simple, safety tool and simplicity mechanism really for fintech platforms and wallets and exchanges that want to offer a stablecoin without worrying that they'll have to switch which stablecoin they're depending on, right? Like let's say that you're, a fintech platform and you're like, okay, we want to offer our users a balance in stablecoins so that they can withdraw and do things on the blockchain and so on, or get those transaction properties. You have to pick, well, which company do you want to be dependent on? And you have to contend with the possibility that that stablecoin could get shut down or it could depeg, and you would have to then migrate your users over to something else. And that's something that anyone who is deciding what to offer on their platform is going to be thinking hard about these days, now that those things have actually been demonstrated in reality. And so I think we'll find out over the next couple of months, because I think our team is probably going to go back and have a bunch of conversations, oftentimes with people we've met before, like maybe that person I just referred to from the conversation a year or two ago, and say, hey, now I think that you can understand why this makes sense. So as you're thinking about crypto and stablecoins in the future, keep in mind that if you use an RToken, if you offer an RToken to your users, it has all these obvious tangible benefits. And so we'll see how that goes. But I think there've been actually a couple of early conversations just in the past few days with CEOs of fintechs in Latin America, where they have expressed interest in eUSD for that reason. So who knows? I'm not saying that anyone's going to integrate it because of that, but maybe they will. And so I think that is the natural narrative shift that can happen. Now, I do think that even though I'm super excited about the demonstration with eUSD, it's still way too small for anyone to really care in a big way, right? It's like people who are paying attention to Reserve, we're all cheering and we're like, yes, look at this, right? But still, the vast majority of people in crypto haven't even heard of eUSD. They have no idea that happened. No reporters reported on it. And so there's still kind of a further step of like, well, what if eUSD had been $100 million instead of $1 million? What if it had been $1 billion instead of $1 million? And it had handled that whole situation without breaking a sweat? Well, that would obviously be much bigger news. So the ecosystem and the protocol still has a lot to do to prove itself on that mechanism that it hasn't done yet. And I think that there's, in a way, it was a great test of the mechanism, but it wasn't actually a great stress test of the overall economics because of the fact that there were so many stakers who were staking just because it was new and they were excited to stake, I think, right? It's not realistic, I don't think, at scale to have over 100% over collateralization. I expect something closer to 20% or 30% or something in that neighborhood for a coin like USD. So, that still would be fine if all you have to do is cover a 2% shortfall, but still it's kind of like, yeah, this is cool, but like, does it really mean it's going to be fine when USD is at $1 billion? We still have to prove ourselves, or the protocol still has to prove itself in that respect. So I don't expect there to be like a massive narrative shift where suddenly everyone is in our corner and everyone agrees. But I do think it's a very positive and concrete incremental step that will be especially helpful in cases where we're having direct conversations with people, or where anyone on this call is having direct conversations with people, be it on Twitter or on a video call, and having the opportunity to point to this example and be like, look, here's how it played out in practice. That's a lot easier to understand than like, let me walk you through this mechanism that's all hypothetical. So yeah, I guess that's my take on how the narrative will change.
That's very interesting. Do you think that like Taleb would describe the protocol as anti-fragile if he were to examine it?
It's a great question. Taleb is an unpredictable person in terms of his reactions to things. So who knows? He might have terrible things to say. He might describe it as anti-fragile. He might think it's awesome. I would love to know. I would love to know. I would love to describe it to him and see what he has to say. I wouldn't count on it being positive, but be curious. Maybe we'd learn something from him.
Yeah, hopefully he doesn't call you any names.
Yeah.
Okay. I think back to Malo here.
Sure. Kind of a two-part question, really, because it's about RTokens, but it's also about eUSD. So is our MobileCoin, because I guess they created eUSD, are they happy for anyone to pick that up in some sort of app or in a fintech wallet or whatever, and that they're okay with people saying, okay, yeah, we just think we'll use eUSD because I can't be bothered to create an RToken, and that one looks good enough for me, so let's go. I'd rather push my sales front end rather than worry too much about the mechanics of an RToken. But having said that, we have seen some stuff being pushed through on GitHub for, I think, lsdETH and Lido wrapped ETH, which I think the guys who won the competition on the hackathon were using. So I'm guessing that with some development on the GitHub side and some deployment of plugins that we might see one or two new RTokens.
Yeah. So, I mean, on the first point about MobileCoin, I do think that they're happy for anybody to use eUSD. The more people use eUSD, especially if it's on the MobileCoin chain, the more value that provides to their users. So certainly, I don't think that they want it to be a walled garden. I think they would like it to be integrated in many different wallets and for users to use it in different places. So, and I think they're pretty stoked about RPay using it as well. So yeah, definitely. And the name eUSD, I think was perhaps a strategic choice in that direction. They could have called it, the MobileCoin dollar or something. But by calling it eUSD, I think that sort of signals an openness. It's like we're not claiming ownership of this. Yes, we created it, but it doesn't have our brand name on it in an explicit way. It's something that anybody can use. And then, yeah, I think there are, I think that the team might have even prioritized some finishing some collateral plugins in order to enable some of the coolest things that were discussed during the hackathon. And that's something that I think that people should expect. If there's a cool RToken idea that somebody pitches, and they're like, hey, I want to build this, but I need this further collateral plugin. That's something that our team could do. It's also something that our team could put into a hackathon bounty. So even if we don't develop it, simply if anyone on the call has an idea for an RToken that requires a collateral plugin that doesn't exist, you should definitely say so, because that will be taken into account by our team, and those plugins can come into existence. So I don't personally know the details of if and when lsdETH that was proposed in the hackathon will be deployed, but I would guess also that it would be soon. And I guess maybe now is a good time to talk about these next couple stages of this hackathon that's underway. Is it cool if I talk about that now?
Mm-hmm.
Yeah, sure, go for it.
Cool. So at ETH Denver, there was kind of, I think, phase 1 of 3 of this current hackathon series that Larry the Cucumber and others on the Reserve team are implementing. Actually, I think Larry's on the call, so he'd probably be better at talking about this than I am. Hopefully I don't mess anything up here. Actually, is it possible to just bring other people up? Because probably be better to have Larry explain it than me.
Right now.
Cool.
Hey guys.
Hey Larry.
Hey.
You guys hear me okay?
Yes.
Yep, great.
Awesome. Yeah, did you want me to take it over from here? Chat about the hackathon a little?
Yeah. Why don't you talk about the current state of the hackathon and what people can do in it?
Yeah, I don't know if all of you saw, but today we announced the hackathon page that went up, and so I'm sharing it in the chat now. it, in my opinion, looks pretty awesome. And it lays out in, very clear detail what phases there are, the 3 different phases. The first of which concluded in ETH Denver, where we got a lot of cool hackathon, or a lot of wacky RTokens idea submissions, and we're actively working with a number of them to get them deployed into RTokens. And so that is actually informing how we're prioritizing certain collateral plugins. So that was a good win from the perspective of knowing what the market would like in terms of how our tokens can most effectively or most immediately be developed. The second stage, which is currently active, are the collateral plugins. We have 11 that are listed, Uniswap, Morpho, Gearbox, for example. And these are just what we judge to be the biggest DeFi protocols that we'd like to see be possible for use on the Reserve protocol as our token collateral. There's a $3,000 bounty for successful completion of each one. And so yeah, we invite all developers to sort of hack on these. I did this myself in the first hackathon. It was a lot of fun learning about, 1, the Reserve protocol, and 2, how it integrates into external DeFi protocols. So really good learning experience, and overall, so I recommend this for any developers. And so, and there's a month remaining in this phase. The deadline is the 15th of April. And lastly, there's the RToken adoption, which has $25,000 of prizes available for people who launch successful RTokens, judged by a number of different metrics. There's TVL, number of depositors. There's, $1,000 bonuses for people who execute successful governance proposals. And hopefully they're not, as high stress as the ones we've had to do recently with eUSD. But that is going to be announced soon, and the intention is to release it once some of the most useful and high-yielding collateral plugins are developed, such as those for lsdETH derivatives and convex pools, because those are generally some of the more high-yielding products in DeFi. But yeah, that's it from a high level.
Awesome, thank you. And so yeah, so I think like concretely, if you're not a developer, that third phase is maybe the most juicy and interesting, because all you would have to do is create an RToken that has an interesting basket that people would want to use. You have to figure out how to name it and how to brand it. That's up to you. And then what to do to initially get people to use it. And I believe that the prizes there are, I think it's going to be like over a 30-day period, whichever RToken has the highest TVL on average over any 14-day period during that. Correct me if I'm wrong on that, Larry, but gets a $7,000 prize. And I think that there's maybe a second prize of $5,000 or something. And then there's a separate category, which is not about the TVL, it's about the number of holders. So even if yours doesn't have the highest TVL, if you manage to get the largest number of holders on average, I think again over a 14-day period during that window, you can also get a $7,000 prize. I guess one RToken could potentially win both of those if they really take the competition by storm. But so, it requires some skill and some investment of time, because you have to get people to know about it and use it, at least in a small way. But it doesn't require any development skills, as long as you're down to deploy something with the existing governance framework and collateral plugins that have been written by the time that phase starts. You could participate there. And there's a couple of things I want to follow that up with, which is for anybody who deploys an RToken, one thing that I personally feel strongly about is that the brand should not be piggybacking on Reserve. It shouldn't be like the something Reserve token, or or using the term RToken in the ticker symbol or anything like that. The brand should be its own standalone thing, because I believe RTokens are their own thing. They're their own product. They should have their own identity. And this might mean that it's a little bit more difficult to figure out a brand and to sort of get legitimacy at the beginning. But I actually think that it can be more powerful and more popular over the course of time. And it kind of goes back to that branding decision the MobileCoin team made to call it eUSD rather than something that is super MobileCoin affiliated, because it sort of says, this is a thing that anyone can use. It just is its own thing. It's a new kind of standard, the electronic dollar. Here's how it works. And similarly, I think that it would be great for all our tokens to take an attitude like that, to not sort of be part of the reserve bubble and try to have everything sort of point back to reserve, but rather to say, hey, here's this new thing. Yeah, it's built with this reserve technology, but it has its own identity. It's its own thing. And there's one other reason why I feel strongly about this, which is that some RTokens will be poorly conceived. Like, we can't limit what people do with RTokens. So there'll be some cases where an RToken has a highly risky basket or governance parameters that don't make sense or something. And so there will be instances of RTokens falling apart, I think, if people end up doing them irresponsibly. I mean, maybe that won't happen, but it's always a risk. And so it's important to me that if or when that happens, it doesn't bring the entire reserve brand down with it. And so that's another reason why I think it's beneficial for RTokens to have their own brand identity. That means they have to sort of earn their own reputation and credit, but they'll be stronger once they do, I think. And then if something bad happens, they don't sort of take down the reserve reputation with them, or at least not as much. And so to that end, there's no, I do think that like it might be that like our company technically has like legal authority over the reserve trademark and like could like go sue people if they use the reserve logo or something. Hopefully that we didn't have to do something like that. But in terms of like, will we help promote an RToken with our resources? If an RToken sort of violates that request and has a reserve branding, probably we won't. Probably we'll actually be much less helpful to that RToken. And so it's in the interest of RToken creators to go along with the core team's request in that respect, because we'll actually be more cooperative and helpful in trying to get it off the ground if it's branded in a way where it has its own identity. And then the last note on branding there is that I think that naming and branding are super important. I think it's actually maybe the hardest part of deploying an RToken if you're using existing collateral plugins. For anyone who's seen our video walkthroughs, it's very easy to deploy an RToken. And often when you're starting a project or a company, the naming takes an unusually long time, and it can be frustrating to figure out like, well, what is the right name? Making a logo is usually easier than making a name once you figured out the name. But if you're naming a token, you're always having to worry about like, well, what's the ticker going to be? And so naming is very complicated, and then the graphic design is not easy. You need someone who has that skill, and that's something that I encourage people to seek help with. If you have name ideas, run them by other people in the Discord. Hang out on a call and brainstorm about it. Ask me and the team about it. We've thought a lot about naming and branding in the past, and we're happy to help because I think it's really important to get that right in order for RTokens to be understandable and attractive and usable. If we end up with tons of RTokens that have kind of silly naming and branding and they all kind of look janky, I think that that's not a good place to be for the initial budding of the reserve ecosystem. So I strongly encourage everyone to invest effort in naming and branding if they're going to create RTokens. And then I guess, okay, last thing to say here is that even beyond the hackathon, even if there weren't these prizes in play, RTokens are an opportunity for anyone in the community to make money. Because if you deploy an RToken, you can direct some of the revenue to yourself. And I think that that revenue share mechanism is the most sustainable if you do something in an ongoing way to support that RToken. I believe, for example, that the lsdETH design that won our hackathon, the sort of pitch hackathon, has a plan to direct some portion of funds to not just a single individual, but to some sort of multi-sig that represents like a DAO that will look after that RToken and do things to support it and promote it. And I think as long as that DAO is actually doing its job, it's in the interest of the governors of the RToken to continue paying that cut of the revenue to that DAO. And I think that we're going to see some cool stuff in that sense. But the point is that if you deploy an RToken and you direct some of the revenue to yourself, you'll at least get a cut for a while as sort of a founder reward. And if it gets popular, that could be very significant, very meaningful amounts of money. And then if you do something in an ongoing way to continue earning that cut, like it can be a sustainable business that you could run essentially. And so I think we're in this interesting moment that I analogize to kind of like right after the Ethereum mainnet initially launched. If you go all the way back to that time, almost nobody knew about Ethereum at the time. And even the people who knew about it, there's even a smaller set of people who really understood how it worked. And then of those people, there's even a smaller set of people who actually could, write smart contracts for Ethereum and actually do stuff on top of it. And so even though there was this enormous amount of opportunity to create applications on Ethereum and issue tokens and bring in lots of money and so on, there was this tiny set of people who knew about that opportunity and who could take advantage of it. And so, if you look at, I don't know, for example, like the MakerDAO team, like those people understood what could be done on Ethereum very early. And because of that, had this position where they were able to create a protocol that has been quite successful and is sort of one of the leading DeFi protocols, in part because they were there at the very beginning and had the knowledge and the insight to take advantage of that opportunity. There are many protocols now that work similarly to Maker that are sort of copycats, but none are nearly as large. And it's because of that timing. So people who are part of the Reserve ecosystem right now have that same kind of opportunity to be a first mover because they understand how this works. They understand what an RToken is. They understand or could easily learn how to deploy one. And there are certain types of RTokens like a yield-bearing dollar or lsdETH basket RTokens or other things that people might come up with that maybe there will be over the course of time, there could be dozens of different competitors trying to get that market. But if you're the first one and you name it well and you promote it well, then there could end up being network effects that no one can really easily compete with. And so simply by deploying RTokens early on, you could end up making a lot of money and doing something that's pretty prominent and really appreciated. Simply because you were in the right place at the right time. And so if you're in the Discord hanging out with us right now, you're obviously in that right place at the right time. If you're listening to the recording, you're in that right place at the right time. And so, basically we've entered this moment where now it's possible to do that. And there's kind of this big opportunity there. And, we decided as a core team, we're not going to do it. We're not going to take that opportunity away from people in the community. We're going to leave that to the broader Reserve ecosystem because we want it to bud and develop as an ecosystem, not just be something that's run by people who work for one particular company. So now is this exciting moment where I really think that it's a great time to, if you're an entrepreneurial person, to jump in and learn the details of how RTokens work and compete and deploy one. And you could end up with like an enormous income stream if you do that successfully.
I guess it's it's almost like the community learning, as you say, a bit like Ethereum. But I think James likes to talk about AWS and Netflix. So AWS enables companies to brand and to deploy content, but they don't necessarily rave about it being on AWS. You just see Netflix, and Netflix has a
Right.
great product
Right.
because it's built
Yep.
on AWS.
Yep. Totally. I love that.
So I was listening to a podcast with Thomas on the DeFi flywheel, and he was talking about how eUSD, the electronic dollar, had taken its name from PayPal. Is there any way you could tell us more about that?
I actually didn't know that was true.
Okay. Yeah, I was surprised to hear that too.
But that's cool if so. I feel like maybe Henry said something about that, but yeah, I don't know. If that's true, then I'm not sure.
Did they mention it was from the PayPal wars that Eric Schmidt wrote? I can't write. I don't remember properly.
They did say it was from PayPal wars, or Thomas did say that.
Okay, cool.
Yeah, Eric something. It's not Schmidt. Eric
Jackson.
Smith, Eric B.
Mac Jackson.
Jackson. Eric Jackson. Yeah.
Jackson. Yeah. Why am I? Oh, God. Don't know where I got that from.
What do you think the M stands for? Michael Jackson. Anyways,
must be.
we make that. Anyways, okay. So how about this? So I have this question, and it could get very long. So I'm gonna kind of pare it down. And so I had this idea when I was talking to Malo the other night, and essentially, could you make like a credit? And so like I know there's a lot of like back end infrastructure problems with this probably, but could you make a credit card that is, basically when you point it into a terminal or into a POS system, that it more or less just reads what your account is, sends you some sort of quick quick hey, this is the amount, and then you just say yes, instead of having to have like full blown POS. It's a very poorly thought out question. I'm sorry. I had to move a whole bunch of different things, but maybe we should just skip it. Never mind.
I think no. I think I see where you're going with that, and it's something I've thought about too. Like, there's this weird way in which the card network today, you don't have public and private keys. You just have a single number, and so it's like, hey, here's my number. Just take funds from me. And the problem with that, is that basically it's so subjectable to fraud and scams that, debit and credit card processing companies end up having to have these whole like machine learning models and so on that try to guess, is my customer being defrauded? And then say yes or no to processing the transaction. So I don't know if you guys have this problem. For some reason, I have this problem like pretty frequently where like I'll just go to buy something online or something and it just doesn't go through, and I have to try another card. And then like, I don't know, occasionally it just like doesn't go through on two cards at once. And it's not, I'm not doing anything wrong. I'm not buying drugs or something. It's just like trying to make an all purchase, but the card company, is just thinking like, well, this is outside of the usual spending pattern, and so we're going to decline it. So if you could have a system where you initiate a transaction with, scanning a card or whatever it may be, and then the user is basically prompted like, hey, are you trying to buy, this, book on this website or whatever? And you just tap yes, and then by tapping yes, you're signing, with your private key to make the transaction go through. Then basically you would never have the problem of your card being declined ever again. You would have to tap yes every time you want to make a payment, on your phone or whatever. But that seemed like I would make that trade-off. I would definitely prefer to, have a way to authorize transactions. And and not have to deal with like cards being declined, and also, not have to worry about my credit card number floating out around on the internet and potentially being defrauded, right? It's like that, all that exists because the fraud is real. So yeah, I mean, I don't know if that's exactly the way you're thinking about it, but like, I totally think that that could be a thing. And I think that if we're going to use stablecoins for ordinary commerce, there could end up being different, online and in-person point-of-sale systems that work similarly to that, because you do need to protect your private key. You can't have the same sort of situation, and this does end up being a problem for like subscription payments, right? One nice thing about the card number system is you can give your card number to a trustworthy company, and they can just bill it once a month until you turn it off. Well, with a crypto transaction, you can't do that. The user would have to be prompted every month and authorize the transaction, unless they want to hand over their private key to a company, which they would probably not want to do. So I think that there will need to be infrastructure built to make subscriptions as low friction as possible with stablecoin payments, and they'll have to work in the way that you're talking about with like a prompt to the user.
Yeah, so like maybe an authenticator app would be one way of doing that, where it changes every 60 seconds, that sort of a system. But yeah, it was kind of like going along the lines of, if there is some sort of crypto credit card, that isn't issued by Binance, and you keep your BUSD on Binance, and then they withdraw from it, etc. What sort of a system would be so much better than what we have now? And you could have credit card terminals that only need an internet connection, and they basically just send a message to your wallet or to your account on whatever app you're using, and then you just say yes, and then that's kind of it. But yeah, it was also, how do you do self custody with credit cards? Because you have to do that authorization, like you were saying, or else it gets very messy, possibly. Yeah, but anyways, that was basically it. So, thank you.
Yeah.
I think, well, because we're going to be time constrained in a few minutes, we'll try and finish up with a fairly simple question, hopefully, fingers crossed. We did get asked, we put on Twitter, and I think somebody's mentioned it today. If we do imagine a scenario where we have an RToken which reaches 1 billion market cap, for example, you probably touched on this before, but if for some unknown reason, because our RSR stakers are earning a pot of, I don't know, $100 million or something like that per year, and it's only 20% collateralized, is there a possibility of the price of RSR not being high enough in order to fully make up any difference if a peg is dropped or if something defaults?
So you mean like there just wouldn't be enough RSR value?
Yes, there wouldn't be enough RSR value in dollar terms in order to plug the hole. I kind of know what the answer is going to be, but anyway, that's the question.
Right. Yeah, it's a reasonable question. Let me see how to explain this. So let's take that example. There's like $1 billion RToken, and let's just say that, let's say that the price of RSR, let's say that the market cap of all of the circulating RSR is only, let's say it's only like $10 million, which I think, let's see, that would be, I think that's 1%, right, of a billion, 10 million. So then, and then let's say it's all staked on that RToken. So, or it's, it's unrealistic for it to all be staked on the RToken. Let's say it's, 90% of it is staked on the RToken. So you have like roughly only 1% coverage 1% over collateralization. That would be kind of the fear, is like, well, what if it's not really enough to supply meaningful over collateralization? Well, let's say we're talking about USD here, and let's say it's earning 2% on the collateral. So then 2% of $1 billion is going to be 20 million in annual revenue that's going to the stakers. So if you had that situation at a moment in time where you had $10 million worth of RSR staked, and they were earning collectively $20 million in revenue per year, then they're earning 200% return per year. That's obviously extremely attractive. And so what I think would happen, who knows how the market would actually act. It's a market, it's not perfectly predictable, but if that situation existed, I would certainly be incentivized to go buy up some of the, the 10% of the RSR that's not staked on the market and stake it. And in order to get my share of that 200% return per year. And the idea is, basically, as long as that situation persisted, many people would want to go make that trade. But every time that trade is made, you're locking up more of the RSR, but you're also buying up the price of RSR on the market in order to get your tokens into that position. And so that's going to be making the market cap of RSR go up, and it's going to make the value of all the RSR that's already staked go up. And so both of those forces, staking more RSR and buying up the RSR in order to stake it, will bring down that 200% return. Until a point where it's only 20% return or whatever, such that people stop rushing in to buy. But by the time you've done that, by the time the remaining RSR has been bought up in order to stake it, you would assume that the market price would be driven up to the point where it's no longer an attractive, or it's sort of on the cusp of being an attractive trade, and then you would reach a new equilibrium. And so I would predict that you would end up with a situation where you wouldn't just have 1% coverage, you'd have something closer to, who knows exactly what it'd be, but like maybe somewhere around 20% would be the value of the RSR that's staked on that R token at a scale like that. Nobody knows exactly what the numbers are. I posted a poll on Twitter a week or two ago to ask people, at what APY would you actually go stake your RSR on eUSD? I just wanted to see what people thought. And I think the options were like 5%, 10%, and 15 or 20%. I forget exactly, but I think 10% was the most popular answer. So I think, if there's greater than 10% APY being offered, we can see, at least from that poll, which I think a couple thousand people responded to, that that there will be demand to take unstaked RSR and stake it. And so that gives us some indication that we should expect, the APY to settle maybe around 10%, maybe a little bit lower, because some people are willing to stake it at less than that. And so that's the mechanism at play. And so I would expect that the RSR price and market cap would end up rising in that particular scenario. Again, not here to predict RSR price rises, but that's the sort of economics of that situation as best I understand them.
Yeah, I mean, it's not surprising to say that market efficiencies would basically take up any opportunity, and it just depends, because it's so transparent and it's so quick to act upon. Then you would expect it to equilibrium somewhere, rather than just get run away with the possibility of 200% gains for a year. I can't imagine that the market would possibly allow that to happen. So I guess but ultimately the value of RSR is kind of reflexive to the market cap because of the rewards that are given back.
Yep.
So
Yep. I think that's right.
Okay, cool. Well, we've hit your hour and 45, Nevin, so I guess we should let you go. But thank you very much for taking the time out to speak today. Thanks very much for great content as ever. And I'll say thank you, and thanks everyone for listening. And we've got this recorded, I'm pretty sure, in at least 2 places, so we'll get it put up online for people who couldn't make it. But thanks for future people listening to this, and go out there and create our tokens.
thanks so
Excellent.
much, everybody.
Yep. Thanks for having me. Yeah, great to hang out with everyone, and I'll catch you guys soon.
Thank you. Take it easy. Thank you,
Okay.
Nevin.
Thank you.